Welcome back to Property Investing Today with your hosts Howard Bowes and myself, Grant Paul Adams. This week we're discovering that topic that all of us are afraid of, but many of us use to a huge advantage: bridging finance. Something that certainly can help investors when they're trying to buy properties quickly, and if they're buying them with the aim to get it mortgage ready, even to flip over. So Howard, when you think about bridging finance, why is that more beneficial to someone than, say, a regular mortgage? Or, when is the right time to use a bridging loan?
Great question, Grant. Yeah, so with bridging loans, really, the right time to use them is not for speed. Most people think that you take a bridging loan for speed, but that's actually a myth. The reason you take a bridging loan is when you've got a highly profitable deal, but that deal is not mortgageable, or you're looking to flip that deal. Okay. So, we see lots of people who are doing or try to make bridging work buying a typical 3-bedroom, perhaps terraced house, in areas where there's lower values, higher yield, and they're going to do a 20 to 50k refurb, let's say, on these type of houses. And it's really difficult to make the figures work because the bridging loans, they are expensive loans. So the best time to use the bridging loan is when you've got more than one uplift in a property and when it's highly profitable. So we see them being used lots for title splits, conversion work. So when you're converting a regular house to a HMO, again for commercial to resi. So perhaps buying an old tired office block and turning it into a group of apartments. Those are the type of places when bridging really come into their own.
Yeah, and I think we're starting to see a lot of that, aren't we? The commercial to residential changes and making those into blocks of flats in particular at the moment, or even just converting it so you've got flats above them from old offices. Because of the way the high streets are going, it seems to be a very popular choice amongst lots of investors. What is the time difference as well between that and a mortgage? Because if we're looking at bridging, generally speaking, we're not looking at 10, 20 years, are we?
No, exactly. So your typical bridging loan could be as short as 1 month. It's pretty rare that you'd only take a bridging loan for 1 month. There are circumstances where that applies, but obviously if you're carrying out improvement work to the property, that's going to take some time. So
exactly,
what we see is a minimum term generally of 3 to 4 months, and the maximum term that most bridging lenders will offer is 24 months, 2 years. But as a standard sort of time frame, most of the bridging loans we see are between 9 and 12 months.
Yeah.
The important thing to remember about the term that you choose for your bridging loan is that it's not just about how long it's going to take you to carry out any refurb or improvement you're doing. You've also got the contingency time that needs to be built in, and you've got run-off time after that. So are you going to sell the property, in which case it's got to go onto the open market as a flip, and you need time for your buyer to buy it while you're still on your bridge, or are you going to refinance it? Well, when you're refinancing, of course, you're not going to get the valuer to come in and value for your refinance until you've got the building looking as good as you possibly can.
Exactly.
So that means that you can't really start that process until you're kind of, say, 2 or 3 weeks before you're completely finished. You can start your remortgage application then. The valuer comes in those 2 to 3 weeks later once all the snagging's done and it's looking its best. But then you need a run-off time for offer and legals afterwards. So if you're selling, you need at least a 3-month run-off is what we recommend after the refurb. And if you're refinancing, depends on what your exit lender is, but at least 2 months is realistic.
I think that makes a lot of sense. And, we do this all day, every day. So recommending that people take just a slight longer term is way better than trying to make it fit into a period where it's too short. But I guess the $1 million question, what happens if you get to the end of your term and you haven't completed? What happens at that stage? Is it all game over? Does the property get taken off you? Or is there a little glimmer of hope that makes it more impressionable than perhaps the worst case scenario? Yeah,
of course. So to clarify, what you're saying is you take a bridging loan and you get to the end of your bridging term and you haven't refinanced or haven't sold at that point. The bridging lender wants their money back. So a couple of important things here, and it is, it's really important that we cover this because it's punitive. The pecuniary costs, the costs in default for going over on a bridging loan are hard and harsh. And sometimes the monthly cost of the bridge can double or triple. So £100,000 loan, let's say it was costing you £750 a month while it was on the bridge, could be costing as much as £3,000 once you go over. Plus there's other costs. And some of the lenders, of course, some of the bridging lenders, if you've got more than one bridging loan running at one time, they cross-collateralise the contract. So if one goes into breach, they breach them all. So even if the other ones weren't over their term, they treat them all like they're over their term, and suddenly you've got these costs times 3 on 2 or 3 projects. That's if you're financing with the same bridger more than once at a time, which we don't always recommend you do for that reason, because if one project goes wrong or it becomes difficult, you don't want it to bring your whole house of cards down. So probably not great advice to have more than one bridge simultaneously with the same lender. But in terms of what happens, the bridging lenders, there are those that are aggressive, and there are those that are quite relaxed. But the important thing is communication. And so, if you come into the end of your term, you're coming to the end of your term before the end of your term. So you don't leave it till a week before the loan is due to be called back and then call the lender or call your broker, Harvey Bowes, in a panic. But we'll be in touch with our investors anyway, coming to the end of their projects. In fact, you and I just last week were out visiting our clients' projects, see how they're getting on. When you take a genuine interest, then it's a little bit different. But so you want to be prepared and you want to talk in advance. Also, you want to make sure, and we always give the right advice for the right lenders. We know which lenders are very aggressive and we know which lenders are less aggressive, more comfortable when there's communication. They'll always give you a bit of a runoff. So, they come knocking the door, and there will be some charges, but they're not difficult in the most part about going over by a month or two, particularly if they've seen some progress and you've actually refurbed it and added value. Correct. Because of course there's always equity in that building, particularly if you've added that value. So you're fairly safe with many of the bridging lenders, although there will be costs. The best thing to do is to get into a new deal. So if you need a 3-month extension, just renew for 3 months, takes the pressure off. And then even if they retained the interest previously, we'll come back to what retained interest is, but even if they retained it previously, when you're on this new extension to the bridge, then they will probably want you to pay it monthly. So you've got to find quite a big monthly cost to do that out of your cash flow. So that's one key thing. I mean, the other thing, Grant, as you know, so many times we recommend that our clients do a 6+3 type scenario.
Exactly. Yeah.
So this is where, and this is key. So this is where in a bridging loan, you have the retained interest first. So they hold back 6 months worth of interest at the beginning. And by doing that, you have no monthly payments on the bridge. So that's what they normally do. And of course, most investors are looking for the bridging loan to be as short a term as they can manage realistically for the project, because the longer the term, the more interest is deducted, the less money the bridging lender lends you on day one.
Yeah, absolutely.
So the idea, really, the perfect scenario is that you get, let's say you think it's going to take 9 months to do the project, including any contingency and runoff. You do what's called a 9+3. That means it's actually 12-month pre-approved bridge. 9 months worth of the interest is retained at the beginning, and then you've got that runoff contingency of 3 months already pre-organised. Yes, you've got to pay the monthly payment for those 3 months on the bridge, which is expensive, but not in a default scenario. So you're not being charged extra or any punitive or pecuniary costs for that.
Yeah. Now, the important part about that, and I think this is where people forget that bridging has some real quirks that make it very different from a mortgage as well. Let's say you decided to follow the advice that we give, to do the term of how long you think everything is going to take plus 3 months. What happens if by any shape of miracle you end up finishing that project early and refinancing it early or selling it early? What happens then? Because you've already factored all of that interest in up front, haven't you?
Exactly. But and it's a great point. We would never advise in the Harvey Bowes team anybody took a bridge where the lender held onto or retained unspent interest. So let's say, for example, you take a 9-month term, you've finished it out in 6. Great project, you've done really well. The lender will, although they've withheld that interest up front, they will refund those last 3. They'll credit it back to the account so that you don't lose those extra 3 months in interest.
So the interesting thing I find about this, if someone was to say to me, oh yeah, but over a 12-month period, my mortgage might only be 5 or 6% interest, but the bridging loan might be 10 or 13%. The difference is, if you finish that project early, in the grander scheme of things, if you did it in 6 months, it might only be 6%. So that can make quite a big difference. But obviously you see the benefit of that at the end rather than at the very start, I guess.
Yeah.
You referred to a couple of points in the last question, that of retained interest, serviced interest. We know that there's three ways really that you can work with the lender to get that money and to maximise the amount on day one, or to make it cash flow better throughout the term of that bridge. We've got retained interest, serviced interest, and then rolled up interest. We know what they mean because we do it all day, every day. But what do those three scenarios mean for people that perhaps are brand new to bridging, or they're looking at pricing up their next deal?
Yeah, great. So serviced interest is, that's the term used where you're going to pay the interest monthly. So let's say it's a 75% loan to value bridge. The bridging lender will give you all 75% against your purchase price, and each month you're then paying that monthly payment towards the bridge. That's a serviced bridge. A rolled up bridge is where they give you all of the money, so they give you the full 75%, and on top of that the interest then accumulates on top of the deal and you pay the interest at the end. Now that's very rare, and it's for very particular types of deal, and the deal has got to be very good to get any lender to support that, because the lender is carrying a lot more risk in doing that. And then the last and most popular is retained interest. So that's where they might lend you 75%, and they say over a 12-month period our interest on this is £1,000 a month, is 12k. So they deduct the 12k, you kind of actually get in your pocket towards the completion, say 67% or 68% usually loan to value, and you pay no monthly payments, and then when you refinance at the end the lender gathers that interest in. But in effect it hits you at the beginning because it's deducted from the amount they give you.
Yeah, so you have to factor in a lot more money. So you're losing a few percent at the beginning rather than having that full 75, a bit like you would if you was going onto a standard mortgage. But there's another massive difference between mortgaging something that needs some works and bridging something that needs the works, and that's borrowing the works funds. Where is that going to be particularly relevant, and how easy is that to access for people that need to refurb a property?
Yeah, so when you're looking to borrow towards works, then you can do that on a typical refurb bridging loan. So they'll lend you up to 75% of your purchase price, and then if you've got, let's say your schedule says that you've got 50 grand's worth of works, 100 grand's worth of work, whatever that figure might be, they will lend you 100% of the works money. Now, although they only lend 75% of the purchase price, some people say, therefore, well, why would they then lend you 100% of the works? Well, actually, it de-risks the deal for the lender, because they know that the works will get finished because they're funding it. Yeah. So you as the person who's doing the refurb, the developer, the investor, you're not going to run out of money because it's the lender's money, right?
Yeah, exactly.
So it de-risks it for them, so they like to do that, and they'll give you 100%. The thing to remember though is it comes in tranches in arrears.
Exactly.
So you have to make sure that you've got that money available to do that first tranche. So the minimum drawdown usually with a lender is about 20k on a smaller refurb, it might be 50k on a bigger refurb. So you have to spend out that much money, and then the lender will check you've done the work, sign it off, and then they will reimburse you, and so you've got that to do the next stage. So you kind of need the first tranche, and then it will roll on after that. That's the way they normally do the funds in that way. The other thing that's important though to remember is that if you're using a contractor, there's every chance that you're paying the contractor in stage payments in any event.
Exactly, yeah.
So you don't necessarily need to fund the first stage entirely yourself. You might have a contract with the builder where you're paying all of it in arrears, so there's no deposit down, and once they finish a certain level of build, they will get paid 20 days later or 14 days later by agreement, whatever your contract says, and then of course that means you can get the lender's money in. So actually it's your building contractor that is funding your initial stage, not you. Other circumstances you might be wanting a 10% deposit down for your builder, it depends on what's negotiated, so you might have to fund some of it. And there's other examples of course where you could be running your own team. And so you might be paying the boys weekly and then paying the tradespeople weekly and paying for your own materials and things. And in those situations, well, you've got to manage the cash flow in a different way, haven't you? You might have an account with Howdens or Magnet for your kitchen and your woodwork, and you might be paying them, 30 days in arrears for having the item. So in that way, again, you don't need all of the funds, but you've got to be careful how you manage that process to make sure that you get everybody paid.
Yeah, that makes absolute sense. And those trade accounts are such a great thing for people that are doing refurbishments as well, especially if it can delay the payment of some of those chunks. I guess maybe a question that is part and parcel of this, but maybe it's good to understand this as well. If you're undertaking a refurbishment or something a bit chunkier and you're working with a team to do those works, is there an acceptable amount that you should be paying them up front? So should you be allowing a certain percentage, a certain amount? How would that work? Because you hear stories of things being paid fully up front, small amounts up front, nothing up front. What's the best course of action if you're working with a build team?
So this is speaking from experience after doing many of my own refurbs over the years. What I generally find is on some of the bigger projects we're doing, so I've got a development at the moment of 12 flats, we'll use a JCT build contract for that. We're going out to tender at the moment and we won't pay any upfront money because the size of the contractor we're using won't be expecting to have deposit funds off us. It's a bigger project and we'll be using a bigger contractor. The situation is though, is that a bigger contractor is more expensive.
Yeah.
So even though you're paying them in arrears for the work, in reality you're paying more for that work than you would with perhaps a smaller builder, smaller team. On the smaller refurbs and things that we've done, then generally we've not paid more than 15% up front as a deposit to show goodwill, but generally we pay 10% up front with a smaller contractor. We have seen, you're right, people paying even 100% of the build money up front for comparatively small 50, 60, 70 grand refurb, and unfortunately it almost always ends in tears from our experience. So the difficulty is you've got to get the schedule right. And of course, that goes on to one of our other videos that we've done about how to handle your building contractors and the contracts you actually need and the schedule of payments and the different paperwork you have. You need to have that paperwork up front and in place. And of course, that protects you with the builder. But don't forget, your bridging lender is also going to expect to see that paperwork to make sure your ducks are in a row before they'll release any payments to you anyway.
Yeah, that makes absolute sense. Now, I guess probably the final thing that I think is hugely important, although there's always so many important things when it comes to bridging, what are the major fees that come into play when you're taking out a bridging loan? Again, it is slightly different to the more traditional way that people finance properties or use their own cash. So what type of fees will people expect and what type of deductions are you likely to see on a bridge quote itself?
Yes, so first of all, obviously you've got your interest. So the monthly interest rate. You will also have on your bridging loan an admin fee. So quite common is a 2% admin fee that is deducted from the balance of the loan at the beginning. You'll obviously pay a valuation fee. So on a complex project where you're borrowing money towards works, they will probably be a slightly more expensive valuation fee. So let's say on a 200k project, it could be £1,800 these days for that valuation fee. But the valuer will go through your schedule of works, any design drawings, architectural drawings you might have, depends on what you're doing to the project. So they're reviewing all of that. They're giving you the day one value, so what it's worth now, and then they're giving you the yes, we think your works are realistic, what you've said you're going to spend on works, and they give you the GDV, the gross development value. So they give you that second value as well. Quite often in the community we hear this called the DUV, the done up value. That's a phrase used by some training courses. It's not recognised in the industry as the correct phrase. It's a GDV, a gross development value. So you've got that fee as well, the valuation fee. You've got legal fees. You will usually pay your own legal fees and the lender's legal fees, and typically on an average project that's about £1,200 plus VAT. So you've got that fee to cope with as well, or to factor into your deal. Just going back to valuations actually, of course some of the lenders, if you're doing a simple fast bridge or an auction purchase, they will do a desktop valuation, so they're just looking from a desktop perspective, and those valuations are much cheaper. You might only pay, I've just arranged, I'm buying 2 flats in one of my key cities that I invest in, paying just less than 160k for the 2, and that one's come in with a valuation of £280. But they're doing a desktop valuation on it. So the valuation varies according to the project, what you're doing, and also what data they can get on that area from other properties, other prices as well. And then the legal fees, as you said, the admin fee, the interest, and then there's some smaller fees that you also see. And you still need to factor them in, but you've got your transfer fee for the money to be sent from the lender to the solicitor, normally £20 to £60. And there's also a deeds release fee or an exit fee at the end. Now, if you're borrowing on a development, it's quite common that you'll get an exit fee on the deal. If you're borrowing on a standard bridge or a small refurb bridge, then it's not common to see an exit fee on a regular deal. So just be aware of that. There is a time when an exit fee is applicable though, and it's quite clever sometimes to put an exit fee in. So what you can do is, let's say for example the admin fee at the beginning of the deal is 2%, can actually go back to the lender and say, look, can we do this with 1% fee at the beginning and a 1% exit fee? You're still paying the same amount overall between the two things. The reason why that's a benefit is because you get that 1% extra on day one because it's not deducted from the loan.
Yeah, good point.
So sometimes it's good to have an exit fee in the right context, but not an exit fee as well as the big admin fee, unless it's a particularly quirky deal that where it warrants it.
Yeah, that makes absolute sense. So I guess any final comments on bridging really? Is there anything else that people should be aware of when they're trying to take out this type of finance?
I think many people say that bridging's in the scary box because it's so expensive. I think if you use bridging in the right way, you've got the right mentors, the right advisors, then I think bridging is a fantastic tool to fund deals. And at the end of the day, if your deal has got enough profit in it, if it's a great deal, then don't be scared of the bridging loan. Just make sure you get the right term, so the right length of time for the bridge. Avoid pecuniary costs or penalty costs at all possible ways that you can, and just make sure that you're organised throughout that development. Leave enough time for everything, from if you need planning, leave enough time for your builders and contingency. As we said, leave enough time to refinance or sell. One experience I had a few years ago now is I did a fairly simple flip deal at a time when the market was a little bit quieter. It wasn't as frenzied as it was now, when you could still do a 3-bedroom terrace house with a bridge and make plenty of profit on it. And I did one particular deal where, unfortunately, through absolutely no fault of our own, but the estate agency that we were using at the time was probably not qualifying the buyers well enough, and we had 3 buyers that actually pulled out. That meant that I owned the property for 9 months longer than I thought. The only person who made money on that deal was the bridging lender, because of the pecuniary costs. So, it happens to all of us. I've gone through that experience myself. I did a painful refurb on it and I came out of it with a tiny, tiny loss at the end, instead of a 25 grand clear profit that it would have been if the first buyer had bought it. So, it's surprising how sometimes those things can happen, those twists and turns. Just be aware of that and do your best to make sure you deliver everything on time.
Yeah, it makes absolute sense. Howard, thanks for that today. And I hope you found that super useful as well, because bridging can be a tough subject, but you're never going through it by yourself. Remember, you can always reach out to the Harvey Bowes team and they can take you through it step by step, so you know exactly what you're getting into and you know exactly how to make that type of finance work for your property deals. We hope you enjoy the rest of your week. Have a great evening and we'll see you all again next time on Property Investing Today. Take care.
Looking to purchase a property for investment or development? Look no further. At Harvey Bowes, we pride ourselves in finding ways to make complex and niche deals work. Making sure to explore all the possible strategies and matching the right financing structure to the needs of each investor. Contact Harvey Bowes today. Property finance by investors, for investors.